Most people believe housing became unaffordable because prices simply went up. That's not the real story. Housing didn't just become expensive, it became financialized. And once homes stopped being places to live and started becoming investment vehicles, the entire structure shifted permanently. You've heard it before: buy a house, build equity, secure your future. That advice made sense in a different economic structure. In the 1960s, the median home cost roughly 2 to 3 times the median annual income. A single steady job could realistically support ownership. Today, in many major cities, that ratio has doubled or tripled. In high-cost areas, homes now sell for 6 to 8 times household income, sometimes more. That is not inflation. That is structural transformation. The deeper issue isn't just that prices rose. It's that homes evolved from utility assets into speculative assets. Once appreciation became the expectation, demand changed. Buying wasn't about stability anymore. It became about capital gains. And when an essential good becomes an investment vehicle, affordability becomes secondary. Here's the structural problem. Housing supply does not respond like normal markets. If fewer people buy phones, prices drop. If fewer people buy cars, discounts appear. Housing doesn't work that way because supply is artificially constrained. Zoning laws limit density. Entire neighborhoods ban apartments or multifamily homes. Starter homes disappear because they don't maximize developer margins. Builders rationally focus on luxury units because profit per square foot is higher. Meanwhile, demand is fueled by incentives, tax benefits, and investor appetite. Supply is tight by design. Demand is stimulated by policy. That combination keeps prices elevated even when buyers struggle. Now add institutional capital. Decades ago, your landlord was likely a local individual. Today, in many cities, ownership is concentrated among corporations and hedge funds. Large firms own tens of thousands of single-family homes. They operate housing portfolios the way they operate financial instruments, with yield targets, rent escalation strategies, and acquisition models. You are not negotiating with a landlord. You are paying into a balance sheet. Investor participation has increased dramatically. In some markets, 1 in 4 homes is purchased by investors rather than primary residents. That changes competition dynamics. Families are no longer bidding against families. They are bidding against capital pools with superior liquidity. Add short-term rental platforms into the equation. Homes that once housed long-term residents are converted into high-yield short-term stays. The property remains physically present, but functionally, it disappears from the local housing supply. This is what financialization looks like in practice. But here's where most conversations oversimplify the issue. It is easy to blame investors alone. The deeper mechanics involve incentives. Governments offer tax deductions for mortgage interest, capital gains exclusions for primary residences, subsidies for first-time buyers. On the surface, these appear supportive. In practice, they often increase demand without proportionally increasing supply. When demand rises in a constrained market, prices adjust upward. Affordability programs sometimes unintentionally inflate affordability out of reach. There is also political constraint. Approximately 2/3 of American households own homes. When housing prices rise, homeowners feel wealthier. Their equity increases. Their balance sheets improve, at least on paper. Politicians are hesitant to support policies that materially reduce home values because that affects a voting majority. So the system protects price stability, even when price stability means sustained inaccessibility for new entrants. Now examine wage growth. Home prices have outpaced income growth for decades. Saving for a down payment becomes more difficult because prices rise faster than savings accumulate. Even disciplined savers find the goalpost moving. Renters face similar pressure. In major metropolitan areas, rent consumes 35 to 45% of income, far above recommended thresholds. That leaves limited capital for asset accumulation. And without assets, households remain dependent on income alone. This creates a generational divergence. Older cohorts, who purchased before financialization, capture depreciation gains. Younger cohorts enter markets shaped by scarcity and capital competition. The entry price is structurally higher. So what are the proposed solutions? Land value taxation is one approach. By taxing land rather than improvements, owners are incentivized to develop or sell instead of holding idle property. Zoning reform is another, allowing multifamily units, accessory dwelling units, and higher density construction. Some suggest limiting corporate ownership of single-family homes. Others propose reducing tax benefits for owners of multiple properties. All of these ideas face resistance because they disrupt existing equity positions. Housing policy operates within a contradiction. Society wants affordability for new buyers, but appreciation for current owners. Those goals conflict. And then there is the financial risk dimension. If prices fall sharply, recent buyers may enter negative equity, owing more than the property is worth. That dynamic was central during the 2008 financial crisis. Large-scale price corrections can destabilize banking systems and household balance sheets simultaneously, which means policymakers often choose gradual adjustments over structural overhaul. The uncomfortable truth is this: housing affordability will not significantly improve without supply expansion and demand recalibration. And both require political courage that affects current asset holders. Until then, renting may become structurally normal for a generation. This does not mean ownership is impossible. It means ownership requires strategic positioning, geographic flexibility, capital discipline, patience, avoiding emotional bidding wars, understanding opportunity cost. In some markets, renting while investing excess capital into diversified assets may outperform stretching for ownership at peak valuations. Home ownership is not inherently superior. Asset ownership is. A house can be both shelter and asset. But when purchased at inflated multiples with maximum leverage, it becomes fragile rather than empowering. The real financial shift happens when you stop equating housing with guaranteed wealth creation and start evaluating it as one asset class among many. You assess cash flow, appreciation potential, leverage risk, liquidity constraints, and opportunity cost, just as you would any other investment. The identity shift is critical. From dreamer to strategist, from emotional buyer to capital allocator. Owning a home should align with your financial architecture, not define it. The question is no longer, why can't people afford houses? The better question is, what structural forces determine housing affordability, and how do I position myself within them? If you think long-term, build diversified assets, and avoid emotionally driven leverage, you remain financially adaptable, regardless of market cycles. Housing markets may not reset quickly, but personal financial structure is always within your control. If this perspective sharpened your thinking, subscribe to CAPITRO Mind for disciplined financial strategy and structural wealth analysis. Comment below. I'm thinking long term if you prioritize asset positioning over market narratives.